Good morning, and welcome to the Mahwah Regional Chamber of Commerce Professional Development Webinar Series. Today's presentation is sponsored by R&D Legal Bookkeeping. They manage your business finances so you can focus on increasing your bottom line. Today's webinar is also sponsored by 10-Foot Digital, creating effective digital signage strategy and systems for effective visual communication. And our topic is small business retirement plans. Speaking with us today is Bonnie Yam, the founder of Pension Maxima, a company that focuses on helping companies and entrepreneurs with retirement and exit planning, and financial wellness education. I will hand over the presentation to Bonnie.
Thank you very much, Gary. Small business retirement plans. A lot of people might not be talking about it, but they certainly actively thinking about it. Would I be able to retire? Do I have the cash I need? Anyway, most of us look upon our personal savings, Social Security, assets from our retirement plans for retirement. But for small business owners, a big part of that asset is also tied to their business, and that's a scary part. 75% of business owners' net worth is tied to their business, but only 35% transition successfully. It is not that easy to sell your business, and having so much net worth tied to your business is a scary thing. Why should you set up a retirement plan? Here are the benefits. There's a Roth option, no income limit, unlike Roth IRA. Contributions are tax deductible, and the gains are tax deferred. For employee retention, 401k is a nice benefit, and it's portable. If you leave your company, you can take it with you. It's bankruptcy court protected and good for estate planning. So if you don't need the money, you can pass it to your beneficiary, and they can continue to defer through a stretch IRA. Cost-benefit analysis. Let's take a look at the math. There are two tax savings perspectives. One is the tax deductibility. By putting money in a retirement plan, you report lower income and hence pay less taxes. The other is tax deferral. By putting money in the retirement account, you are not paying taxes on earnings until at withdrawal. Let's look at the first scenario. Let's look at the saving from taxes that accumulates over 20 years. Assume you make $185,000 and you contribute $51,000 to your retirement account. So you pay about $14,000 less in tax. And over 20 years, times 20, that's $285,600 in taxes to be saving. And if you compound that saving at 6% interest rate for 20 years, that's over $500,000. And that's a saving from tax deductibility. Now your question is, what about the $51,000 that I put in my retirement plan? When I take it out, don't I have to pay taxes? All right, so let's take a look. It's still a winning proposition after paying tax at withdrawal. So let's take a look. If you save $100 a month for 20 years at 6% return, you end up with $46,204. Now, that amount, depending on what tax rate you have at retirement, you'll end up with a different amount. So if you're paying 15% tax, your after-tax balance is $39,273. If you're at 28, it's $33,267. And if you're at 35%, it's $30,033. Now, if you look at those bars and then compare against a little chart on the right, even if you're at 35% tax, if you're doing this with an after-tax saving account, you end up with $27,028. And you compare on the right side, 35% tax rate, after-tax balance, after you pay off, it's $30,033. So you still make it better. You're still better off. The retirement economics, what is most important? So if there is something I can tell you, it's start now and put in as much as possible early on. A lot of people worried about what investment options, asset class allocation, what to rebalance, all that. But the most important thing is to just start as soon as you can and let compounding do the magic. And here's the chart that illustrates the break-even contribution percent. If you retiring at 67 and you want to have a 70% income replacement ratio, if you start saving at 25, you need to put in 7%. If you start 10 years later and start saving at 35, you need 12%. And if you don't start until when you're age 45, then you need 20%. So that's a huge difference. A big reason because is they have no access to a plan. Only 50% of the businesses under 100 employees offer a retirement plan. The bigger companies, 89%. For companies with more than 500 employees, 78% with companies between 100 and 499 employees. But with a plan, low-income employees, those people who make $30,000 and between $30,000 and $50,000, they're 16.4 times more likely to save. So why is it that small business owners are not sponsoring a retirement plan? They're surviving. They don't really have the cash. They think that business will provide the needs for them when they retire. And we looked at it, only about 1/3 of the businesses successfully sell off the business and use that money for their retirement. It's not that simple. Setting up a plan seems pretty daunting. It's quite a lot of administrative work, and just don't have the manpower to follow up. And they don't consider retirement. They just don't think, I'm probably not going to retire. I'll just continue to work. So they don't even want to think about that. And we did some informal survey why business owners are not setting up a retirement plan. They think it's very costly. They worried about not doing it properly, not following the compliance rules. And they worried about not having enough people participating. So why are we starting a plan when we don't have enough people enrolling in the plan? And they don't have the extra manpower to handle the administrative work. So what do small business owners want? They want it simple, easy, safe, and certainly not too costly. But setting up a retirement plan is no small task. So they need help. Here's a chart showing the different types of retirement plans that you have offered. If you're an individual, a lot of people just thinking maybe a traditional or Roth IRA. If you're a one-person company, you're a freelancer or sole prop, a lot of people tend to use the SEP or a solo 401k. But for any company with employees, they start thinking about 401k. And sometimes they add on a profit sharing plan just because got more customization, more features. And for small companies who don't really want to deal with any compliance, such as the 5500, which is a tax filing form to IRS, they opt for a simple IRA, or they maybe they will do a SEP. Sometimes they also do a deductible IRA, which is really very much like a traditional IRA, except that you do the payroll deduction. And for somebody who has got lots of income, they probably will consider a defined benefit plan, or like a defined benefit plan / 401k profit sharing. So we call it a combo plan to maximize the deductions. Here are some of these limits. I don't think you should worry too much about it because it's pretty confusing, and every year it changes. So what I want to do is go over some of the main questions. How do people decide? Number one, they want to look at, okay, so how much can I put in? Obviously, if you make a lot of money, you want as much tax deductibility as possible. So we talked about a defined benefit plan, or a defined benefit, defined contribution plan. We call a combo plan. those type of plans, you can put in like over $200,000. And then after that, you want to look at 401k or SEP. The max limit is about $53,000. 401k/profit sharing, we call it defined contribution plan, has two parts to it. The employee puts in something, the company also match. And the two together is like $53,000. For SEP, only the employer contributes. So it's up to the payroll of 25% of your W-2 salary. So it's a little bit different, and the company owner puts in everything for everybody. And then you have Simple. Simple is about $12,500, and then the company has a match of required to match a 3% or 2% non-discretionary match. So 3% match is basically what it means is that the company only puts in when you contribute, and non-discretionary match means it doesn't matter whether you put in or not, the company still put in something for you. So that's the difference. And the other thing they ask is that, okay, good, I can maximize the owner. I can maximize, I want to put in $200,000. Hey, look, so how much do I have to put in for the employee? So that's a very big concern because that's another layer of cost they have to budget for. So for SEP, we talked about the company, the owner puts in the contribution for everybody. And on top of that, if you decide to give yourself 20% of your salary, you have to use the same percent for everybody. You can't you can give one person more. I like somebody more, and I don't like somebody, then I give that person less. So it's a straight percent allocation. You can't discriminate. For Simple, it required a 3% match, which is like I put in if you put in, or 2% non-discretionary match. And for DB, defined benefit, the company, the employee puts in everything, but it has a vesting schedule. So normally it's a 5-year vesting schedule. It takes 5 years for you to get all the money. So first year is 20%, then 40, 60, 80, and finally 100%. And 401k, we talked about there are like two parts to it. The employee part, so that you don't have to take care of, that is their own salary deferral. And normally the company also puts in the match, and you can do same thing, like I only put in money when you put in money, or like I give money to everybody. We call it non-discretionary match. Or if you decide not to give any match, that's also okay. And then the next thing is like, okay, how expensive it is for you to administer. The defined benefit plan is always going to be the most expensive because you need to involve an actuary, and they had to come in and calculate so how much to put in for each person. So there's a lot of math involved. So that is going to be the most expensive. And after that, be the 401k, profit sharing. Simple is much cheaper because you don't have to file 5,500. So a lot less rules. Same with SEP. So that's why, like for a small plan, a lot of accountants think that, okay, you know, if you don't want to be bothered by all the filing, all the compliance, just do Simple, do a SEP. But for a more established company, they probably looking for a little bit more. Features would be a pretty important thing. Like with a 401k, you can have vesting schedule. So even if I'm giving money to the employees, they don't get the money up front. They might have to wait out 5 years. So only those people who stay for me for a long haul would actually benefit the most. And then you can have loans. So the employees don't feel threatened, like, okay, I can't get access to my money. If I really need it, I can take some money out, and that's great. For compliance, like the DB plan, the defined benefit plan, and the 401k plan, every year you have to file 5,500 with the IRS. So that's a pain, and then over 100 life of 401k, you also need to be audited. So that's another layer of compliance. And another thing that people will ask about, so when do I have to set up the plan? It's also very important because a lot of times you do some last minute planning and you realize, hey, look, I'm running out of time, but I have made a lot of money this year. What should I do? Okay. So for 401k, the tax deferral part has to be in by December 31st. And same with Simple. But if you want to set it up, like for Simple, the deadline is October 1st. The money has to come in by December 31st. And for SEP, you don't have to set up until when you file your taxes. and that includes the extension. So that can be next year plus a few more months. And profit sharing DB plan, that takes a lot of planning. So I would probably want to start like around September. The money for profit sharing DB plan, normally they don't have to come in until the company files the tax return, and that also includes extensions too. So let's do a little summary. What is most popular? For sole proprietor, if you don't need to defer a lot of people just do the IRA. You get $5,500 to $6,000 depending on whether you're age 50 or up, or solo 401k. And if you need to file late past December 31st, then you probably want to select a SEP, because that you can tag along together at the time when you file a tax return. For a more established company, you want a 401k. Sometimes you add a safe harbor match. What is a safe harbor match? Is basically the company agrees to match a portion of the deferral, what the employee puts in. And sometimes they can put in something for the employee even though they don't put in anything. That's called a safe harbor match. And the reason that they're doing that is that the highly compensated employees, those that make a little bit more than the average, they can put in the maximum. The maximum is $18,000 if you are 50 and under 50. If you're 50 and above, it's $24,000. And the other reason for having like a 401k is for the flexibility. Loans, and you can determine when they are eligible. Like you can actually stream out a lot of part-timers. You can make the eligibility like 1 year, or you work 1,000 hours before you're eligible. And then the company match, you can have tag along a vesting schedule, so it's not so expensive for the company. But the downside is that you have to file a 5,500 tax return. For a small company, something that has less compliance, you want to think about the simple. It's a slightly lower contribution. It's like $12,500 instead of $18,000, but you don't have to file the 5,500, so that's a lot cheaper. You do have to put a match of 2 to 3%, but there's no loan feature, so it's less flexible. And for a company who's looking for max deferral, max benefit, and all that, you certainly have to look at a defined benefit plan. And I'm talking about a defined benefit plan for a small company, not like a very big company, because it gets very expensive because the company puts in all the contribution. But for like a 10 person company, defined benefit plan actually works pretty well. And if defined benefit plan is not sufficient, normally they also tag along a defined contribution plan. So really that enriches the whole contribution. Now I'd like to take a look at some plan designs. So some people will ask, like, when do I need a TPA, which is a third-party administrator? Those people come in to help design the plan so you can optimize how much you can put in. And we talked about, like, with a SEP, the company contributes everything. So in terms of like efficiency of allocation to the owner, it's probably not very efficient. So what else can we do? SEP, let's just start with a SEP. It's very cheap, very simple. Sometimes the part-time is also eligible, and the employer funds for everybody. For a qualified plan, there are a lot more features. We talk about you can have eligibility, you can exclude part-timers who work less than 1,000 hours. You can have a vesting schedule up to 6 years. It's basically 1 year to be eligible, another 5 years for all the money to be yours. So total is 6 years. And you can also add other criteria such as you had to stay till like December 31st in order to be eligible for the company's money. And you can split different classes, like, different employee groups. These are the rank and file. These are the people that I really want to reward. So you can do a little bit more fancy stuff. And you can also include different types of employees too. So that's why you need to bring in like some type of an expert to run this plan. Now let's take a look at an example. somebody, the owner's 43, compensation is 260, and he's got 3 employees making 80, 40, and 30. So total payroll is 410. If we do a SEP contribution, we said that everybody has to get the same amount, same percentage. So in order to give the owner the max, we have to give everybody like 20%. And that gets pretty expensive. You see that total, we put $82,000 in the retirement plan. The owner only gets 63% of the total because he has to pay out 20% to everybody. Now, let's take a look. What if we do a 401k safe harbor? What we mean is that besides the employee salary deferral portion, the company will give a 3% match to everybody, whether they put in anything for themselves. So let's take a look. Now, we said that 401k, there are 2 portions. One is the salary deferral, and the other is the company match. So in order to give the owner $52,000, he can do $17,500 from the salary deferral, and then the rest will come as company match. And because this is salary deferral part, it significantly reduces the employee contribution. If you recall, with a SEP, we have to give everybody 20%. Now it drops down to 13.3%. So the owner, instead of getting only I think it was 60 or 60 something percent, now, the allocation to the owner is 72%. Okay, so here's this a little summary. 72% versus 63%. So there are some savings right then and there already. And we can do even better. So there are different type of 401k plan, and we're just going to talk about one, and we call this the cross-tested plan. When you contribute to an employee, $1 is different depending on what age you are. Okay, so if you are 25 years old, you have 40 years to retirement, $1 is actually $16. All right, because there's a compounding effect. We assume, let's say 7%, the actuary size. Sometimes it's 5, they can do a 4, they do 7. So $1 at retirement for somebody who's 25 years old is the same as $16. So you don't have to put in as much. So for somebody who's the owner, let's say, who's 55 years old, you can put in 8 times as much versus somebody who's 25 because he's so much closer to retirement. So if he's 55, maybe he's got 10 years to retirement. So that's why he deserves more money. Now, if you look at it that way, as we do the math, you can put in a lot less for the employee. Now, the owner still gets 52, 17,500 from the tax deferral portion, the salary deduction, and the company gives the owner 34,500. Now, the employees now get a much lower amount. Total amount that's going to the employees is only $7,008. And if you look at the total now, the total percent that's contributed to the owner is now 87%. $7,008 to the employees, 52 to the owner. Total contribution amount is $59,838. Now here's the summary. With a SEP, everybody gets 20%. Total employee cost is $30,000. With the profit sharing with Safe Harbor, without that fancy design, okay, it's $19,904. So it's 13.3% contribution. And with a cross-tested Safe Harbor plan 401k, you only pay $7,838 to the employees. Huge difference. So that is why sometimes you have to bring in a third-party administrator, or we call a TPA, to help you to do the plan design. So they need to know basically the census. You need to give them the age of the employee, when they're hired, and the salary. And they do these calculations and they run a few scenarios and see what plan will give you the most without having give away the house. Now we want to talk a little bit about defined benefit plan. I don't really want to go into all that because it's very complicated. But what I'd like to do is just illustrate how a defined benefit plan can substantially increase the amount you can deduct. So let's take a look. So some of us, maybe we start late and we make lots of money. I know a lot of doctors because they went through so much schooling. So the time that they really start saving is like maybe they're already in their 40s. So let's say this person's age 52. He's not that old. He's like, that person's like 50s only, right? He's making, let's say, $260,000. If you look at that, what we calculate, the TPA calculates, that person can put in $181,000. That's quite a lot. So if somebody is looking for some massive amount of deduction, you need to think about the defined benefit plan. Now, this is only the defined benefit plan. So if you want even more, of course, stack on more, add another plan. So let's say we add on the 401k and the profit sharing. So the defined benefit gives you 181, and then 6% profit sharing, 15.6, and the 401k, 17.5, catch up 5,005. You get over $200,000. So I think you get the idea. If you don't have a lot of employees, because like with a defined benefit plan, you'd be paying for the employees as well. So if you want to maximize your deduction, and you really looking for a huge amount, and this is all legitimate because this is a retirement plan, and IRS, Labor Department, they all know about it. This is not like a quirky thing. This is a very standard thing that you can do to help you lower your taxes. So I would recommend doing something like a DB DC combo plan. Now this is a summary. With SEP, you can put in $52,000. Profit sharing, 401k with catch-up, $57,500. Defined benefit plan only without the 401ks, $181. And you add on everything, defined benefit, 401k, profit sharing, $220. So it's huge. Now I want to talk a little bit about multiple employer plan. This is a kind of new concept. It is like a group 401k plan. So instead of everybody set up their own plan, you don't really have a lot of savings because you go for the same administrative stuff. Everybody has to do the compliance. There's a lot of work involved. So what if we put everybody together instead of everybody set up their own plan? How about one group plan for everybody? So there's cost saving, there's reduced administrative burden, and you limit the liability because it's going to be outsourced to somebody who has the experience, who has the risk attorney backup, who has the accountant, the whole setup. So all you have to do is just focus on what you do best. What is a multiple employer plan? It's a collection of single employer plan using a common investment vehicle to obtain reduced pricing. So everybody has to subscribe to just one list of investment options. You can't have different, I want to have this fund, but not that fund. You all have to come together and agree upon just one list of funds. That's the main thing. But there are a lot of other benefits. You can still have your own vesting, your own eligibility, your own match. So that part is customized. And the other benefit is that you outsource a lot of these compliance and administrative work. So you don't have to deal with loans, distributions, and sending out disclosure notices anymore. So that saves the HR a lot of work. And then the third party, the TPA, plan design, all that outsourced. And then you no longer have to worry about the investment selection. It's also being outsourced. So from that perspective, you see that the amount of work, the amount of liability is dramatically reduced. As a matter of fact, if you subscribe to this idea, multiple employer plan, you don't even need to sign your 5500. So if you don't have to sign your 5500, your name is not on any of these documents, you don't have to worry about being sued. So how does this work? So normally, if you belong to a multiple employer plan, there's a board, okay? So 2 to 3 people, companies, they take turn, and they would be presented at year end. everything about the plan, the investment, But if you're not part of the board, it's really very simple. All you do is upload your payroll, making sure that everything is correct, and that's really it. And the responsibilities on the left side, 10, 15 responsible, all that will all go away. So tremendously simplified and make life a lot simpler when you belong to a multiple employee plan. We talked about the some of the important features. It's got flexible plan design, so the employer can decide the eligibility. We talked about if you want to keep out the part-timers, you can set like 1 year eligibility, 1,000 hours. You have to work up to 1,000 hours before you can join the plan. And you can set entry dates like January the 1st and July the 1st. So if you don't fall between those days, you have to basically wait for the next enrollment date. So that adds on some more time before somebody can get on your plan. And you can decide the matching, whether it's like safe harbor or you want no match, whatever. It's all at your discretion. And because you streamline so much, for companies with over 100 lives, their plan needs to be audited. Yes, you still need to be audited, but it's much, much less. Like normally what I hear is like the auditing fees that will come up to like about $17,000, maybe even $20,000. With like a multiple employer plan can go down as much to like $7,500. So the additional saving you can allocate to paying for your payroll or give even better benefit to your employees. So here are the advantages. Time, time is money, okay? And money, because you would see that because of less work involved, that's money, translated to money, less headaches and lower risk because you're outsourcing the investment and the administrative fiduciary. So I did a little bit of comparison against the industry average, like how much multiple employer plan would save depending on the asset size and the number of participants. So besides like doing less work, it's actually some cost advantage for doing this too. And for companies who don't have a 401k plan or thinking about setting one, I would like to encourage them to set up one because you also get some tax credit benefits. If it's a new plan, okay, there's a form 8881, which you can get 50% of your ordinary and necessary expense up to a max of $500 tax credits for the first 3 years in starting a plan. It applies to simple, SEP, and 401k, but it doesn't. The solo 401k doesn't apply. And for employees who are not at a very high income, they also have some benefits. They can file a form 8880, and for single, you can get up to $1,000 in tax credit, and for married file joint, it's $2,000. And here are some of these income phase-out limits: $30,500 for single and $61,000 for married file joint. So we have solutions for different business types, depending whether you are a solo entrepreneur, like a business with like high income or with a lot of staff, or whether you don't want to deal with a fiduciary or just want to outsource it. We have a solution. So that's great.
Okay. Thank you, Bonnie, so much for all that information. We want to take a moment again to thank our sponsor, R&D Legal Bookkeeping, for helping us to keep this webinar going. I do have a couple questions for Bonnie. One thing is this presentation seemed like a lot of information, and I was hoping we could kind of summarize it a little bit. I know in the beginning you talked about pre-tax versus after-tax, and I was just wondering if you could just summarize that. Overall, I think it seemed like most of the stuff you presented was a pre-tax option. Is that correct?
Okay, so yeah. A lot of people, particularly business owners, they care about having the tax deduction today, now. You can have that, but with 401k setup, not for like SEP or anything. Like you can also add on a Roth. It's not extremely popular, although it's very, very nice. And I'll tell you why. It's because like when you're doing the payroll, all of a sudden you have two streams of money instead of one stream of money. So it's more error prone. And to make it a little bit more complicated, the tax deferral part only applies to the salary deferral. The match from the company is still pre-tax. So you have two different sources of income, so you have to make sure that you have it straight. So for if I am like a solo entrepreneur, I would probably do a Roth 401k, right? I maximize, and I don't, and particularly, if I don't have a lot of income, it seems to make a lot of sense to take advantage of maximizing the benefit using after tax income stream. And so when I withdraw the money, I don't have to worry about paying taxes. Also don't have to worry about RMD, which like at 70 and a half, you're supposed to start taking some of the money out. So you don't have like keeping your money in the plan forever.
Okay. I also noticed that you talked a lot about this 5500 form. So is that a form that every employer has to fill out, or is that only if you manage your own retirement plans?
It's only for 401k and for defined benefit plan. If you setting up a SEP, IRA, or simple, you don't have to file 5500. And if you do have a 401k, you have to make sure that you do things properly, because the 5500 will ask you about lots of things, like the assets, beginning of the year, ending of the year, the administrative expense, and number of participants, and your name. You have to sign. So every year when you file something, you have to sign, and you can't be late. There are penalties to it too. And whenever you have to file some type of tax return, that's extra money, extra work, and extra money. So that's why other people opt for like a simple or a SEP, because you don't have to do any of filing.
Right. Or would you be able to hire like a third-party provider that can manage these things for you and take on that responsibility?
Well, normally, when you set up a 401k plan, like let's say you have it with Principal or Fidelity, they will do the 5500 for you, but they don't guarantee that all the numbers are correct. So they'll send you the file. You're supposed to take a look at it and verify that, okay, by the way, these are the numbers, and I think they're right. But you know what I know? They just sign. No, I mean, like, you really should know what's going in. But there are pages and pages of reports, and it's like a huge burden to the business owner to verify all the information to make sure that it's correct.
So that's why you brought up the idea of that MEP.
The multiple employer plan, right. So that reduced administrative work to really the very minimal, very basic stuff of uploading payrolls and making sure that's correct. You have to do that part.
Right.
That's it.
Right. Okay. And I heard something before about when you have these retirement plans, you're acting as like a fiduciary, or you're responsible for the direction of the plan, because you talked about being sued. And can you talk about that a little bit?
Okay, so if you are a business owner, you sponsor the plan. So you are a fiduciary. Regardless of who you hire, you're going to be a fiduciary. You can have an investment advisor, and then the investment advisor will take care of, let's say, investment portion, but you're still a fiduciary because you're the plan sponsor. Now, your question probably be like, what if I belong to a multiple employer plan? How much less fiduciary would that be? So if you belong to a multiple employer plan, what you need to do is just basically elect the board. And once the board is elected, they run the plan. So you outsource everything to the board. And the board, of course, they will have to have their own insurance coverage. And the multiple employer plan is the servicing party takes on a lot more responsibility. So like I would call like a Fidelity or like a Principal or John Hancock, but they add on a lot more responsibility. Fidelity would not want to be a fiduciary for like a multiple employer plan. That means like they have to take on the investment fiduciary and also the administrative fiduciary, which is the loan processing, the distribution, and all that. That is like, unless that you really have a good, strong sense of what goes in, what goes out, it's very prone to mistakes. You know what I mean, right?
Mm-hmm.
So they do not want to have any of that. So you need to streamline everything. You need somebody with internal expertise. So which is why with the multiple employer plan, you have to simplify. What we're trying to do is simplify a lot of stuff and then delegate a lot of stuff that you don't want to do to outside experts. And that's how to make this function really well. Good for you and good for them because they have the expertise. And the other thing is like, you're not supposed to have to create a separate plan for every company. That is a lot of work. So why can't we consolidate and make it run simpler? And through that, save some money for everybody. So that's the whole point.
That makes a lot of sense. So I guess at this time of year, we're about at the end of the year. And the biggest question is what can someone do to maximize their tax benefit for their retirement plans? Can you just give us a short summary of those options?
Because we're so close to the end of the year, it's probably not very feasible to set up a 401k plan. Normally we tell people like the last quarter, like September, October, you really have to start thinking about it. And for simple plan, it's October 1st. That's a deadline. So of course that's way past. The only things left is really just the IRA and the SEP, which is due at the time you file your tax return, including extensions.
Okay. Thank you very much. And so this is kind of why someone would want to reach out to you and ask questions if they have anything else or talk about their specific situation or figure out how to create a defined benefit plan or something like that. So your information is up on the screen and they can reach you at Bonnie at pensionmaxima.com.
Yes. Mm-hmm.
And your website is www.pensionmaxima.com.
Thank you. Right. So I would say, if you kind of don't have to reach the year end, like 3/4 of the way through, you kind of know that you might have some tax issue, but you're making a lot of money and you want to have a good way to minimize your tax bite. You should start thinking about it in September. And the plan designs that we ran through, a lot of TPAs are doing it for free. So if they're charging any money, you can come to me. I can help you. I can help you get some plan designs, and you can. Basically what you need to tell us is how much you want to put in, who you want to benefit, and we can give you a proposal. And when you see how much tax money you're saving, the extra couple $1,000s you're paying for the TPA is well worth it.
Okay. Well, thank you very much. And thank you, everyone, for attending our webinar. We look forward to sharing some more information with you throughout the year. Go to our website at mawa.com to see our schedule, which is updating constantly. Thank you very much and have a great day.
Thank you.